we certainly do see some stretching valuation. So at the moment, we think that stocks are, perhaps 10% overvalued on average. Though that is much less than, say, in the tech bubble of '99, where, according to our estimates in the Global Financial Stability Report, the stretching was twice as much, of the order of 20%.
So it's not .com all over again? In your
Exactly,
view.
it is not. It is not. But having said that, there's very high concentration, right? So whereas in the .com bubble, you saw many companies and it wasn't clear who were going to be the winners, who were going to be the losers. Today we see quite a bit of concentration, a lot of profitability. So a lot of the run-up in the valuations is really driven by profits that have outperformed expectations, but we do have this outsized concentration, and how that interacts with valuations going forward is certainly something to watch closely.
Well, the concentration is around a handful of stocks doing particularly well thanks to the AI story.
Exactly.
But it's also around deals that have been inked, that one company must be buying chips for another to get paid.
Yeah.
Is that circular nature of some of the AI deals also concerning?
Exactly. So that is deepening the concentration in some sense. So we look at a small number of names, and they are getting more interconnected. So that could potentially raise any downside risk if there were negative shocks and there was a reassessment of valuations. We haven't seen that to date.
The US Federal Reserve has been warning about asset price valuations, but it has a dual mandate when it comes to price stability and full employment. Do you think the Fed should be worrying about cutting interest rates from here because of the asset price story, pouring fuel on the fire in a growth cycle?
So the dual mandate is really about price stability on the one hand and full employment on the other hand. Financial conditions do feed into the transmission mechanism of monetary policy, but of course the Federal Reserve does not directly control financial conditions. It directly controls interest rates that then feed into financial conditions. So in the broader picture, in terms of thinking about the mandates, which are price stability and full employment, financial conditions will feature, but it's not in and of itself a target of policy.
Let me ask you about the hoarding that has got into gold. The market is running very hard on a debasement trade, worried about holding US dollars. The money's gone into crypto and it's gone into gold. Are there inherent risks for investors piling into one of those trades that's typically viewed as a safe haven?
Yeah. So gold has always been a kind of hedging asset against high levels of uncertainty. And of course, when we look at policy uncertainty at the moment, so for example, news-based uncertainty measures, those are very high by historical standards. There's tariff uncertainty that is high, there's broader fragmentation uncertainty. And so we really view the run-up in the gold price as a reflection of those broader concerns about uncertainty around the world, really.